Another round of layoffs might be hitting the tech sector just as they gear up for earnings season. That's the focus of today's Tech Check with Deirdre Bosa. Dee, good morning.
Good morning to you, Mike. Now, for a few months this year, tech employees, they could maybe relax a little. The AI hype cycle, it had given them cover from layoffs as companies raced to prove their AI propositions. Now, however, another shift is happening. LinkedIn just laid off nearly 700 employees. Qualcomm is planning to cut more than 1,200 jobs. There's also been a slew of layoffs at startups like Flexport, Stack Overflow, and Bandcamp. And it all raises a question: could more cuts be on the way? Megacap Tech has been all in, of course, when it comes to investing in generative AI. There was Microsoft's deal with OpenAI, Amazon and Google, both pouring billions of dollars into Anthropic, and at most of them, rising capex to build out new data center capabilities. But as one analyst put it, the hype is here, the revenue is not. And the street is starting to notice, too, that tech spending discipline, epitomized by Zuckerberg's year of efficiency, may have been short-lived, leading some to wonder if the strong margin rebounds in 2023 will hold up. Take Meta, for example. B of A expects the company to guide to $100 billion in costs and possibly $40 billion in capex. Morgan Stanley expects Microsoft's capital spending on things like data center and equipment could hit $50 billion in 1 year. At the end of the day, though, the mega caps are still profitable, free cash flow generating, cash-rich companies that, as we've talked about a lot, arguably more defensive than traditionally defensive sectors. And big tech has already made cuts in response to the macro backdrop. So this round of layoffs is hitting another subsector of the tech space and could continue to weigh. LinkedIn's biggest revenue source is recruiting fees. Qualcomm's largest end market, still the smartphone. And startups may be reaching the end of their runway if they last raised money in 2021, when money was much easier raised. So more of a case-by-case basis. So the space to watch now may not be mega cap. We'll see, though, how earnings season goes. But it may be small and medium cap, where unprofitable and economically sensitive stocks are getting hit harder by rising yields. Names that rebounded in the first half of the year, they've lost momentum and backtracked over the last month. Here's a few names for you: Opendoor, Carvana, Affirm, Block, Chewy, all down between 10 and 30% over the last month. Of course, they were hit hard post-pandemic, but they did see some of a rebound earlier this year. That has pretty much disappeared in the back half of the year.